Welcome back to our special coverage of the medium-term budget policy statement as delivered by the Finance Minister, Pravin Gordhan. Now, did the Finance Minister hit all the right notes, and is it enough to keep the sovereign ratings unchanged? Well, we'll delve into that and continue getting analysis on this with our two guests in studio. You too can share your feedback with us on social media platforms at CNBC Africa using the hashtag MTBPS2016 on 410. Well, joining us in studio now is Trudi Makhaya, who is a consulting economist at Mercantile Bank, and Osman Mollagee, who is a partner for international tax and transfer pricing at PwC. Thank you so much for joining us. There's a lot that we'll delve into in the next 30 minutes, but I just want to get an overall view with regard to how you think the minister performed, and if he was able to be agile enough to address as many elements as possible, given that it was a fairly tight rope for him to walk.
Yeah. I mean, there was a lot in that budget. And I suppose, in a sense, he has delivered bad news. He's saying taxes are going to have to increase, expenditure has to come down. So it's a very bitter pill, I think, to swallow. But I think he delivered it gently. And I think he justified very clearly why certain things have to happen. So I think very well argued, very thoughtful. And yeah, I think it hit the right notes, as you say, indeed.
Osman, from your perspective?
No, agreed. I mean, there's a lot that the minister had to deal with, dealt with very tactfully. I think the challenges that he faces in terms of revenue collection and on the expenditure side are significant. I'm glad that he did, allude to the fact that some hard choices will have to be made. He's making some of them already, and he's warning us that some hard choices, both on the revenue and the tax collection side as well as on the expenditure side, are not far away.
Let's touch on the tax collection side as well as trying to beef up on that revenue. We have discussed very briefly with some of our previous competitors that, again, it's about increasing that pie to ensure that growth is sufficient to improve on taxes. But can we afford to increase taxes substantially over the next 2 to 3 years when our economy isn't performing at its peak?
I mean, yeah, that is the conundrum, isn't it? There's a slightly more worrying aspect, which I think has come home to roost to the tax collections, and that is really that the significant shortfall that the minister is predicting for the current fiscal year. So he's talking about 23 billion shortfall in the current year, and it kind of is being blamed almost on sluggish economic growth, but most I think taxpayers, tax practitioners will say there's probably a different reason why there are other contributing factors to why we've had less than expected revenue collections.
What would they be?
Well, I mean, I think certainly one of the concerns, and I'll raise this because this is the kind of thing that we hear out in the market, is that when you have aggressive policies at SARS, and when you have effectively cash being held back, then eventually that comes back to bite you. So in today's statement, for example, the minister mentions the excellent revenue collections at the end of last year, largely because of VAT, meaning they didn't get as many, or they didn't pay out as many VAT refunds as they expected. But then suddenly there was a massive flow of VAT refunds being paid out in April and May of the current year. So what that points to is that we held back funds in 2016 to increase our revenue collection in that year. And this year we're suffering. And the result of that is that now, instead of the originally proposed 15 billion tax increase for 2018, we're now looking at 28 billion to make good what we should have fixed right from the start.
That concerns me because it sounds as though it addresses some of the concerns that the ratings agencies had, which is institutional strength and the integrity of these institutions. Is this perhaps an indication that SARS is flouting on that particular element there?
Well,
without getting into trouble, Osman.
Yeah, no, you're going to get different views. You're going to get different views on that, without a doubt. But certainly, SARS themselves will have various things that they have to balance. They need to. I mean, we've got the pressure. We need to pay for education. We need to pay for national health. So they've got the pressure to maintain their targets and their collections. And how they achieve that, I think that's where the debate lies, about whether we now see a strong focus just solely on revenue collection. And then we start worrying about the minister's other comments about promoting economic growth and making our country investor friendly. And now this is the balancing act, because if we start becoming, and don't get me wrong, SARS needs to be robust, they need to be firm, but they need to be firm and fair. And when investors start seeing, less certainty, and they see, what perceived unfairness, then we start getting to the question of, is this an investor-friendly environment?
You've got me excited and concerned at the same time, and I want to build up on that theme. If 15 billion as a shortfall was too difficult to come up with a solution with, the 28 billion that you allude to here, Trudi, this concerns me, especially given the economic growth forecast that we've been given of potentially reaching 2% in 2018, 1.7 next year, and only 0.5% economic growth for this fiscal year.
Yeah. I mean, it's also clear that in February there's going to have to be new announcements on taxes, on taxation, different measures, which may have a dampening effect on economic growth if it's not handled carefully. In this year's budget, I think the minister sidestepped any income tax increases, anything that would put pressure on households and consumption. And it's not clear if that can be maintained, or whether in the next year something might have to be done on VAT, perhaps, something on the wealth front. So all of that, raises concerns about what will be the reaction to that. If something is done on the corporate tax front, also, obviously there might be, the usual idea that, you make tax collection stricter, you increase taxes, but you actually collect less because the reaction becomes negative. I think one other thing, though, that I was comforted by in the budget was that they issued a fiscal risk statement for the first time. And, the risks that they identify are very much in line with what the credit rating agencies often point out. So I think it sends a message that we acknowledge what our problems are, we understand them, and this is what we're going to do to sort them out. So SOEs were a main feature of this, as always, and the statement outlines the different guarantees and the different liabilities that SOEs are placing on the state. But there's also, a counter to that, to say this is how we're fixing up state-owned enterprise management in terms of shareholders. There've been new boards appointed at some, at SAA and others. They're finally working out this idea of separating the commercial imperatives of SOEs and from the development imperatives, because often they get confused, and then all of that hides bad performance, because then SOEs always say, but we're pursuing developmental objectives, this is why our balance sheet looks so bad. So it looks like they're finally dealing with that issue. They're dealing clearly with shareholder expectations. I think if they manage to achieve all that with SOEs, then that risk would be alleviated, and I think it's a convincing way to try and say, we understand what the issues are. I think the biggest open risk that is mentioned is unanticipated expenditure, because by its nature, you don't know what that is. So I think the statement mischievously points to higher education and says, like higher education, we don't know what else is coming. And this is the problem. In a society where there's so many legitimate demands, it's not clear where the next demand is going to come from, where it's going to flare up, become very loud, contested, violent in the way higher education has. And, then there has to be further adjustments to take care of that. And the reserve in the budget, the reserve contingency is almost exhausted. So, that is a major risk. There could almost be a shock if there is a huge, there's significant pressure from any grouping in society that puts that. Then in terms of social spending, I was a little surprised that, the minister very excitedly announced a 10 Rand increase in the social grant. In real terms, relative to inflation, relative to what food prices has done, that really is it's very marginal in the bigger scheme of things. But then again, where would he get the money to push through a more significant increase?
Exactly. To come back to the risk that you alluded to, though, including the unplanned expenditure pressures that might rise, he also alludes there to the potential of an increased wage bill. If we take a look at this unforeseen expenditure that does come up, hopefully it doesn't within the next fiscal year, but does that necessarily mean that we might have to go back onto the market and perhaps seek some kind of assistance from our international counterparts, or you look at alternatives for raising capital when we already have the debt pressures we do have?
Look, he also said very proudly that we have a heritage and a past of not going with a begging bowl to international, partners. Obviously, we could tap into the debt markets to try and raise more debt, but clearly it has to be within that 48% debt to GDP ratio, which is already quite high. I mean, he did point out that local debt markets are also quite robust, so there's always room to get more financing from there. But I think overall, there really isn't enough room to tap into international markets to increase our debt levels or our exposures at the rate that we're going. So it's going to be very much around, reducing expenditure, being more efficient, and, going as far as possible with local markets. But in terms of, our credit rating and all of that, you really can't push too hard on the debt side.
Exactly. I want to pick up on another theme that you mentioned and also alluded to as in the financial risk statement, which is the state-owned entities. There's a headline doing the rounds of one of our colleagues in our media industry, and they say nuclear. What nuclear? Clearly because the minister didn't address it quite aggressively. So is this also a potential risk element?
It's very open. I actually said this is going to be in future risk statements because now all that is being said is that it's going to be led by Eskom. So one imagines a project finance kind of approach to say we ring fence nuclear, it has to generate revenues to fund itself, either through user payments over time and doing it gradually. But it's going to be very, very sensitive. National Treasury is basically an advisor in all of this, but the Department of Public Enterprises has to lead. So, I mean, it's not impossible to imagine a scheme where it becomes self-financing. But I think with the economy where it is, with the general challenges to user pay principles that we've seen with e-tolls, for instance, and with the very limited number of vendors who are able to provide nuclear solutions and the power and influence they might have, it's very difficult to imagine that at some point there won't be recourse to the national budget. Because even if it's not financial outflows, they'll need a guarantee from the state, which is already very much stressed in terms of guarantees, and which puts a certain cloud over the strength of our finances. So from that perspective, to say it'll take care of itself, I think is quite naive, and it might end up biting, coming back to bite Treasury. Whereas with NHI, it seems as if what's being established is a gradualist approach. Every year there's a grant here, an allocation here to test some aspect of NHI. So that seems to be, so far at least, being managed quite conservatively. Whereas with nuclear, it's just open. You don't know necessarily where it's going to go. So that's, I think, a major risk going forward.
Exactly. Osman, I want to get your views and comments here, because we are focusing quite extensively on the expenditure part and some of the concerns that have been highlighted. Given that you monitor these tax practices and partnerships from an international point of view, whilst we're struggling to increase the revenue base, are there lessons that we can learn from our international counterparts in similar financial positions as to how best to manage that expenditure?
Well, I think you're absolutely right. The discussion really at the moment has got to be around expenditure. But having said that, when we kind of comment on how well the minister has done, we have to equally recognise that expenditure is one of the areas that he probably has least control over. So he can set expenditure cap, but we start talking about SOEs, we start talking about government wage bill, the use of the word advisor to other departments. That's really where his hands are tied. So in terms of managing our deficits and giving advice on what would be the best practice of how we go about spending, that certainly has come through and continues. I mean, it's always come through in this minister's speeches. So, but we have to also recognise that he doesn't have that much control over that. Having said that, if we turn to the revenue side, where he does have slightly more control, the difficulty there is that he also has less control over economic growth in general. So economic growth in general will will depend on factors like what's happening at Eskom, what's happening in labour, and so many other factors. And one of the impacts that the Minister of Finance has on economic growth will be revenue. And so it becomes a little bit of a difficult balance for the Minister, because in order to increase his revenue, he will almost inevitably be stunting economic growth. The question is, how much and how much is enough, and tied to that, even if we are able to increase revenue through increased taxes without having an adverse effect on on economic growth, the balancing act there, or if we are concerned about the economic growth, is if we don't contain expenditure and we start increasing borrowings, the closer we get to, and let's just say the closer we get to 50%, the more likely we end up in this vicious cycle where we are just remain constantly unable to repay our debt, and that'll almost guarantee a downgrade if we go in that direction.
Sure.
So increasing revenue, obviously that is the need of the hour. Specifically because of this budget deficit problem that we do have.
With a tax to GDP ratio around 27-28%, though, how far can we push that before we reach the limit?
Well, I have to say that kind of goes to general trends within the rest of the world, and if we look at coming back to the point about economic growth, the tax to GDP ratio is an indication of how investor friendly, one indication of how investor friendly our environment is. So
the lower it is, the more investor friendly it is.
So if we are competing with investment destinations in other parts of the world, we have a relatively high tax to GDP ratio. So certainly going above 28% is not an area where we want to be. I mean, we spoke about raising specific taxes, and if we talk about personal income tax versus VAT versus corporate tax, our three main contributors to the South African revenue. Corporate tax is where we are amongst the highest in the world.
That's why people go to Mauritius. Right?
Well, they don't end up there. But certainly with I mean, if you let's use a country that is not considered to be a low tax jurisdiction like the UK, where the corporate tax rate is at 20% going down to 18% over the next 2 years. So certainly that's who we are competing with, and the bitter, political pill perhaps is that by comparison our VAT rates are not that high. So from a kind of comparative perspective, if VAT went up by, I mean, just to give some numbers, if we were looking for 28 billion for next year, that's 1.5% increase in the VAT rate, and we'll get our 20. In fact, maybe just 1% if we add maybe the under 10 billion we'll get from the sugar tax. So if we're going to get close to 10 billion from the sugar tax, maybe 5 billion. The jury's still out on that. But we can probably get 20 billion from a 1% increase in VAT rate. And that is politically seems to be very difficult in this country at the moment, but it actually is comparable to what's happening in the rest of the world.
How do you expect, naturally, because we know that that's a very contentious issue heading up to the 2019 elections, is it even an option at the moment and something that we could see potentially being tabled next year, Feb, if the situation gets dire?
But can I say, I mean, on an open question, I think it's very difficult for any government to raise taxes from a political perspective. So, except for constituencies, perhaps they see as marginal. So perhaps wealth is never really, really off the table. But of course, it affects confidence and growth, so that would have to be taken into account. But I think one area that's open is that there's a lot of insinuation and some studies around illicit financial flows and, unaccounted for taxation. And there's been the voluntary system
disclosure
that's starting this month, so perhaps it's still too early to see where that's going to go, but it's open how much revenue that could raise, and so perhaps there's still a bit of glimmer of hope that if that surprise is on the upside and people do the right thing, that might also be a great contributor, and also I suppose a sustained contributor, because once those people are, or those entities are in the tax net properly, then they will keep paying tax going forward. So I think that there is a bit of hope that you don't have to do the most difficult things. You could still try to close the loopholes that you're finding. I think on economic growth itself, another point that I found interesting was that in this growth scenarios that Treasury was pointing, they had 3 scenarios, and the most optimistic scenario depended very much on a weak exchange rate boosting exports. Which hasn't been the case in the past. In Q2 of this year, it was the case. Exports increased by 18%,
right?
And we had trade surpluses. So from that perspective, and perhaps even manufacturing sector rebounding, that perhaps also is a glimmer of hope to say, the exchange rate is a negative on some expenditures, government expenditures they're having to procure internationally. On the other hand, it might boost on the growth side. But it does worry me.
Because you can't control the currency
process. It worries me
process.
very much that, so much, the most positive thing that they could come up with in the current environment is actually exchange rate depreciation. So I think that is a bit depressing to say there wasn't enough on structural reforms that would boost, as Lisiba was saying earlier, potential output. It's actually just an opportunistic way to take advantage of the current situation with the exchange rate. So I think that suggests that even if we do rebound, unless the structural constraints are taken care of, we will consistently have problems and we might stagnate for some time.
I'm glad that you bring that up, and I want to actually focus on it a little bit more, the growth element and actually propping up growth. We know that the private sector, despite the initiatives that they've put in place with regard to the Jobs Fund as well as the CEO initiative, are still sitting on quite a bit of capital and not deploying it into the market to try and increase the economic participation here. We know that from the SARS perspective, they're looking at inflation figures, and with all the global factors at hand, they're likely to perhaps maybe increase interest rates very slightly, but their focus is not growth. So how do we actually identify parts of opportunity to grow that pie so that we get increased taxes and revenues and see that diminishing in inequality and increase employment?
I think I think the ultimate thing is confidence there. It's very hard to say there's the one thing that will happen that will unlock that expenditure, but I think if there was a sense that really policy uncertainty was a risk factor in the risk report, which is quite disheartening. Government is responsible for policy, and when part of government says uncertainty is an issue, you kind of think, well, this should be resolved within government and come out with a clear statement about how you're moving forward from that. But I think without that confidence element being bedded down, we'll always have this issue. Another, I suppose, disappointing factor in this medium-term statement, and I suppose over the past few years, has been on public-private partnerships. So once again, we learn that, for instance, in airlines, they're still looking for transaction advisors are still thinking of ways to restructure. There's been a coal IPP, so there's some movement on some elements of government in terms of that. But I think if they just opened it up, have a challenge and say, private sector, come up with ways that you think, business plans that you think would contribute to improving service delivery, taking off the burden of government on some commercial entities. Don't even constrain it and say we're only looking in these areas. Just open it up, have a marketplace of ideas, have people kind of almost compete to come up with ideas. I think that could unlock some creativity. Whereas that part of the development of the budget has been very, very, very slow and very careful. And I understand that there's politics to it. But I think that would be almost a bit of an olive branch to private sector to say, we want you to participate and, give us your ideas.
So true. Takes a new level of thinking and a mindset there, certainly.
Yeah, and I don't want to talk about it too much, but certainly the comments about the policy uncertainty is potentially a positive in the same sense that the actual existence of a risk statement is a positive because it's acknowledgement of a weakness, whereas I think maybe this is potentially the next step, because in the past, we talk about public-private partnerships, we could probably say that the absence of clarity on policy might have been a problem, but in the past there wasn't even an admission that we have a policy uncertainty. At least we've got to we've gone out of the denial stage, saying this is a problem. We don't have consensus. We don't have clarity of policy, and we're admitting that. The next step now obviously needs to be solved.
At least let's hope that they do certainly solve it, and that the minister will still be there in February to also help address these issues with some of his counterparts in the many other ministries. But as we round up our conversation, in my previous panel, I mentioned to the two speakers that what are your concerns with regard to what the minister didn't address that he should have addressed in this particular midterm speech, and secondly, how you would receive this if you were a representative of the ratings agencies. Osman, let's get your view.
Okay, well, I'll deal with the second issue first. As far as the ratings agency is concerned, I think Minister Gordhan knows what the issues are and he's addressed them head on. So I think they well, they are being told what they need to hear. In terms of what we see as being the problems and how we seek to address them. And I think the transparency, the relative transparency there is, for me, I think the rating agencies will take that as a positive. I have to say, one of the things that if we go to your first point about issues that were not addressed, I do have to say, I wish the minister would have spoken more about the relationship with SARS and SARS's relationship with the taxpaying community. But for me, that is kind of on my wish list. I can't say I'm really disappointed, because it's not that unexpected that it wasn't covered in the mini budget. But it would have given where we are, the relationship that we need between government and business, and the increasingly strained relationship because of SARS aggression. It would have been helpful to have some kind of commentary about what the intentions are forward with SARS.
I get you. And taxes are playing a more prominent role now with the mini budget, as we've seen. Your closing remarks, Trudi?
I think this medium-term statement was very much about managing the risks and the challenges in a very constrained economy and keeping it on a steady, path. At some point, we're going to have a more, I suppose, aggressive approach towards structural reform, towards competitiveness. I mean, he alluded to barriers to entry, the work of the competition authorities, the work of the International Trade Administration. I think all of that needs to be more front and center, issues around the minimum wage. So there are lots of, I think, open questions about how do we take this to another level that perhaps he didn't have the space to address, A, in a mini budget, and secondly, at a time when I think the here and now is more important. But I think that work has to happen fairly soon, because then otherwise we don't see how we get out of this less than 3% economic growth path that we seem to be stuck in.
If you were Moody's, Fitch or S&P, what would you do?
I think I would keep the ratings pretty much. Maybe Moody's, might consider a downgrade to just one level above investment grade. But I think I would still keep investment grade because I think the acknowledgement of the risks, it's still open on whether the mitigating solutions are going to work or not. And we're still in line with our peers. Many of our peers who are still investment grade. So I think it would be, a bit premature to downgrade given the fundamentals.
Well, we'll leave it there for today. Thank you so much to both my guests for sharing their insight on the post-analysis of the mini budget, which has been delivered by the Finance Minister. A big thank you to Trudi Makhaya, Consulting Economist at Mercantile Bank, and Osman Mollagee, Partner for International Tax and Transfer Pricing at PwC.